Thank you very much, Ian. I'd just like to say I agree with everything I've just said with Sharon. I think a couple of points there in terms of asking questions, giving it a go, relationship. Everything that's happened to me has been completely by accident to a degree. I've asked questions, I've had a go, I've spoken to private equity guys and bankers and funders and people who've been there and done it. And I find myself here rather by accident. And the other reflection on relationship, as I'll come on to at the end of the presentation, we're going to our next venture with the same management team, the same backers, the same board, same PA, same almost everything. And if there's one observation I have looking back on my experience at SpiriTel, is the relationships that I developed during those years have lasted much longer than money will do. So, I think we've got a presentation hopefully it's going to appear on the screen, although I've since found out that some of these slides are going to appear blank on the screen. Maybe we don't have any slides on the screen. Oh, there we go, yes. It's not coming up, there we go. So, build it, scale it, keep it. That was the brief that Ian gave me, which is fairly appropriate to SpiriTel. By way of introduction, I ran an AIM-listed company until November last year. And going back before that, we had a legacy wholesale business that was in a pretty ropey situation. And then in around 2005-06 time, we raised some money from private equity, put some debt funding into it as well, and then embarked on an acquisition on a roll-up strategy. We made a lot of mistakes during those years. I look back and cringe very regularly. But as time went on, I'm pleased to say we made less mistakes. We got better at it. The model seemed to work. Profits went up. And in the end, we had a fairly successful exit last year. Looking back at last year, it feels like we left, in some ways, at the wrong time. We were on the crest of a wave. Everything seemed to be going swimmingly. But with hindsight, it probably was the right decision in terms of the exit that our private equity guys got. But for me, I don't think I'll ever go through the learning curve that I went through. I'll never ride that roller coaster again. And there's a part of it that really struggled leaving the company behind. I don't think I'll ever work harder or sleep less than I did in those few years from 2005 when we set up the company. And I often used to tell people that I genuinely felt that I had the best job in the world. And I think some of that goes back to the people that I worked with. And interestingly, it was that team of people put together with the acquisition program that made it as much fun that it was and delivered those sorts of returns that I'll come on to for our investors. So I've just got a few minutes to talk through that story, how we did it, why we did it. Am I supposed to be pressing a button here? There we go. So I'm very quickly going to talk through 4 points. Firstly, a few stating the obvious points in terms of how the market is changing. Forgive me, I'm going to talk about the telecoms market. It's the market that I operated in, and how we considered those elements in terms of our strategy, in particular the acquisition side of things. Secondly, some fairly textbook growth strategy ideas, and how you can retain and how you can regain growth. Thirdly, what we did in our 3 years at SpiriTel, and finally, SpiriTel 2.0. We're about to embark on our new strategy. We've got 3 acquisitions planned this month. Hopefully our first one's going to be through next week. Although, people please say it's not going to be called SpiriTel 2.0 when we launch. So here go my blank slides. I want you to imagine on this slide there is a graph, and it's got 1, 2, 3, 4, 5 blue columns that goes from left to right, and a big arrow that goes up like that. And what that graph describes, if you can just imagine it for a moment, is growth in telecom. So voice and data for the last 5 years. You may not recognise the products, but you'll recognise the trends. And since the invention of the phone, voice and data spend has gone up every year, absolutely without fail. It's a great market to be in. But then, as we go on to the next slide, as you can see up here on the right-hand side of that, there's a red column, and it's much lower than all the other columns. Something has gone wrong. Because, as you can imagine, what happened in 2009, according to Ofcom, was that the first year since the invention of the phone, it's gone backwards. The market has started to go backwards. Voice and data spend for the first time has gone backwards. And I've just seen Ofcom's Q4 stats. Fixed line down 5.5%, mobile down 3%. So it wasn't just a recession thing, I don't think. Something structurally has changed within the market. And for some, that is a very, very scary thought, and it needs a response. So here we go, we've got one graph here. This is just one little anecdote within the overall market. That is called fixed to mobile substitution. Fixed line going straight down, mobile going straight up. Now this is minutes, not revenues, but there's a little bit of a flavour in there to say that even though you're operating within a market which is structurally in decline, perhaps there are some areas for growth in there. And this probably won't surprise you. If you use your mobile phone sitting at your desk instead of your desk phone like I do, it won't come as any surprise at all. Apparently 40% of all corporate mobile calls are made from within the office, within easy reach of a mobile phone. Now that's very scary, that graph, if you're in the fixed line space. And if you're BT, I don't know if we've got anybody from BT here today. Have we got anybody from BT? In which case I'll call them that smallest telecoms firm with a large pension fund attached to it. That is a really scary statistic, especially when in the 1990s you sold your mobile company. However, I should caveat the fact that BT are doing tremendously well since then. I think they've got things right in terms of their overall network provision. So this is the next graph, which is another one of those blue columns, arrow going up to the right. And what this one shows you is there's a graph on the left, an axis on the left-hand side, it's got 130%. What this graph would tell you is that there are now 1.3 mobiles for every person in the UK. We've got complete and utter saturation of mobile devices. I don't know where that graph's going to go. The graph isn't there where it's going to go in the future. I don't know how many devices we need in the UK. And then within mobile, there's another blank graph. And on this one, it's even more exciting. The growth is even more exponential. So within mobile growth, this graph would have shown 3G growth. So you remember in the noughties, as it was called, there was this massive explosion of rather inappropriately named dongles, that everybody had to get a dongle. It was all about 3G data growth. Now, as it happens, that has started to tail off. But the point I'm trying to make is within a market that was struggling, was flat at best, always declining, there were some really exciting growth markets within there. I read recently that Gartner think that by 2013 more people will be accessing the internet via a mobile phone than via a fixed terminal. None of us could have imagined that only 5 years ago. So within the overall mobile growth, there's some real standout themes. And this is, I read in that very reliable source of all statistics called the Metro on the way in on the tube, although they were quoting Cisco, but I just found this absolutely staggering. By 2015, there are going to be twice as many internet-connected devices in the world as there are people in the world. 7.5 billion people, 15 billion interconnect devices. Just incredible. And you can imagine what that means for data connectivity. For those who provide data connectivity, it's quite an exciting proposition. I know I'm bombarding you for a moment. I'm going to move on in a little bit to what our response was to it. This is a really important trend, and this is probably the graph that has most informed our decision making in our new venture. And all this tells you is there's a big migration in the overall telecom sector from voice to data spend. So 100% being the full proportion, that trend is not going to reverse. Things like smartphones, things like software as a service, cloud computing, we're going to keep going in that direction. And this has started to flow through to company results. So many of you will have seen, or some of you may have seen Cable & Wireless's results last week. Cable & Wireless Worldwide, not to be confused with Cable & Wireless Communications that does their worldwide bit. There's a very strange naming strategy. Cable & Wireless Worldwide is mainly UK corporate. Their voice spend down 5%. Their data revenues up 2%. For the very first time in that bellwether of British telecoms, data exceeded voice. So they're no longer really a telecoms company as such. Similarly, Vodafone reported results the week after. An even larger change in their profile of business mix. Voice revenues down 2%, data up 26%. Now you can see on this one there's still quite a gap between where voice revenues are and where data revenues are, but you can imagine in terms of the strategy director of Vodafone what this means in terms of where their money's going, what they should be doing in terms of deploying capital and so on. So you're left there, or I'm left there, in a market that I operate in thinking, how do we, if you're running one of those sorts of companies, how do we retain growth? How do you regain growth? Because some of them, let's face it, have now lost growth, so it's all about regaining growth. What is very clear, despite the stats being a little bit random and some of them not even being there, what is very clear is the market is changing. What is less clear, I think, is how to respond to that. Because for years, all we had to do was just sell the same products in the same industry. You were in a structurally growing market, and you could also gain market share from BT. So it was very easy to grow. We're faced with some very serious challenges, and this is from probably, I don't know, I've never done an MBA, but if you get an MBA textbook and you turn to the growth strategies, you've probably got this on page 1. Forgive me if I'm telling you everything you already know. There's 3 obvious options: build, partner, or buy. They're very traditional growth strategies, and the reason I'm happy to put it up there, even though it's quite, it's a bit Jack and Jill stuff, but these are the very things that we faced back in 2006-07. We had a company, share price had crashed, the company was insolvent. I'd just taken over as CEO, didn't have a clue what I was doing, feeling completely overwhelmed, and we genuinely went through these 3 ideas at a board meeting. Should we build? Should we partner? Should we buy? And in the end, we thought, death or glory, let's go for it, get some money, and go and do some acquisitions. Very briefly, advantages and pains. Well, the obvious advantage of doing things organically, and I use this phrase, it won't break the model. If you've got a company that's kind of going okay, you're going to change things organically, you're not betting the ranch, you're not going to break the model by going in that direction. It's a sustainable approach, and of course it's a lot cheaper than doing acquisitions, but it is very, very slow. It takes a long time, particularly in a dynamic market, and sometimes too long. So by the time you've developed a product organically, the market will have moved on, you've been left behind, and you're absolutely no better off. But I do want to stress this point about the learning curve. Do not underestimate how painful it can be to change and develop a new product in a dynamic market. Many of you will have done it and succeeded. We tried to do it and failed, and I don't want to do it again. That whole process of learning what your customers need, learning how to support them, making sure the product is robust, making sure you've got the right systems to support it, is just a complete nightmare. And the advantage of the acquisition side of things is that it's instant. You get, I call it sometimes the Haribo effect. I've got 2 boys. If I put Haribo in the youngest one, he choked. But in the oldest one, if you fill him up with Haribo and give him some of your Coke, you get an instant hit. It's quite a sight. And acquisitions are like that. You get instant capability, you get instant earnings enhancement, you get instant credibility. I remember we were a company, so we set up SpiriTel business from scratch. And I remember we bought a company that had been around for 11 years, so suddenly we were an 11-year-old company. We were going out telling people, a well-established company being around there for 11 years, instant credibility as well. But it is expensive, and also don't underestimate the distraction of doing deals. We did 12 in a 3-year period, and believe me, that is all I did, almost all I did in my whole life. What I haven't put on here is there's also a risk that you just become a deal junkie. There's a little bit of an adrenaline thing about doing acquisitions, and suddenly you don't really want to do the day-to-day business, and you're not interested in your CRM, you're not interested in which version of Sage you've got. Anyway, I could talk about that another time. But the third real risk of this, if you get a big acquisition wrong, you're screwed. You've broken the model, it could be all over. It is not without its risks. But it's happening. People do acquisitions for the reasons we've just discussed. We've seen Microsoft buy Skype recently for $8.5 billion. Obviously, they haven't done that for the earnings enhancements. Nobody buys Skype for the earnings, do they? But they've got capability, and they've got a customer base, and they've got that in an instant hit. They could have built it. Microsoft have got more cash in the bank than they know what to do with. But then those issues in terms of the learning curve and the speed to market would have been a real challenge for them. A week later, I read that Microsoft might be buying Skype for $18 billion. That one seems to have gone quiet. But you could see why the bankers were all frothing at the mouth at the idea of getting that deal done. Big ticket deal, but it gives Microsoft an instant hit, an instant capability straight in their bank for the sake of $19 billion. Now that wouldn't break their model, but if they got it wrong, it wouldn't be very palatable for the investors. You probably haven't seen this deal unless you're operating in our space. What we're seeing here is a traditional telco seeing all those slides that weren't on the screen earlier and thinking, how do we respond to that? So Verizon do basic telecoms on the whole, but what they've done is they've gone and bought Terramark, who are a data center company with managed services, hosting, cloud capabilities. Bang, suddenly they're a cloud company. Suddenly, instant hit, they're straight in there, with all those benefits that they couldn't have had before. 1.4 billion, again, it's not a big issue for Verizon, but they've got credibility, they've got capability, and they've got scale in that area. And this is absolutely pure speculation, this is not insider knowledge, but for a long time I've been saying I think Vodafone or O2 will buy TalkTalk. I could talk for another few minutes about TalkTalk. Revenue's going down, EBITDA going up, not sustainable, they're doing through cost cutting. But what Vodafone and O2 would get in TalkTalk is scale. Now the interesting thing is that both of those companies have dipped their toe in the water. Vodafone bought a company called Central Telecom. O2 have done their thing called joined up communications. So they've sort of done a bit of it, they've tried it, and we can all do that with our companies. You can do a small acquisition, you can do a little bit of partnering, but the time is coming, most analysts would agree, that a deal needs to be done. And don't be surprised if one of those guys buys TalkTalk to give them that fixed line credibility and capability in one Haribo shot. So acquisitions can be transformational. It doesn't just give one acquisition, it could be a series of acquisitions, it can still be transformational. You get that instant benefit. But I would like to stress, I've put on screen there several big hit acquisitions, big ticket items. We didn't do it that way at SpiriTel, we didn't have the luxury to do it. I went to our backers and said, look, should we do some acquisitions? There's no way they were going to write me a £10 million cheque at that stage. They gave me 2 million, then they gave me 3, then they gave me a little bit more. However, the impact was no less transformational for us through a series of acquisitions. So very briefly, and I'm starting to head towards the end, what did we do at SpiriTel? Between 2007 and 2010, we spent about £19 million, £8 million of debt funding, £11 million of equity. We did 12 acquisitions. We did 12 acquisitions, and we set up what we call the complete business communications product portfolio. Our idea was that customers wanted to buy more services from us. So we bought a mobile specialist, then we bought a fixed line specialist, then we bought a data specialist, then we bought a Wi-Fi specialist, and suddenly we could do the whole lot, which not many other people could do at that stage. And in the end, we were delivering 22% organic growth, which was market leading. We had £35 million in revenues by the time we exited, and we had some pretty big customers for a company of our size. We went from 0 to 170 staff in the space of 2.5 years, offices across London, Cardiff, Wigan and Glasgow, which gave us UK coverage. And at the point of exit, we've grown our EBITDA up to £7 million run rate. It's here, which is great. We had 22% organic growth. And I love this slide. It's a real reminder of what the guys achieved at SpiriTel. Back in 2008, bottom left-hand side of the graph, we bought a company who had this customer. It was a London brewer, and that customer spent £8,000 a year with us. We managed one of their telephone switches. It doesn't really matter what the product was. Later that year, we bought another company that could do voice over IP and Wi-Fi. So the account manager, who previously looked after the customer, said, Andy, IT director of the customer, can I bring in one of my colleagues? He does VoIP and Wi-Fi. Yeah, of course you can. So they both sat down, and this guy sold a VoIP and Wi-Fi service, and this guy sat there and said, that's great, because I'm going to get half of your commission. They shared the commission. That was an additional £20,000. Later in the year, the guy said, I really like that service that you sold to me, so can I roll that out across my estate? Another £75,000 spend. The guy's thinking, this is fantastic. I just bring these guys in and they sell and I get half the commission. We then bought a company that did network services, actually based just around the corner here, and then the guy said, well, will you come in with me to the customer as well? And the customer said, oh, can I buy that from you as well? That's fantastic. That was another £210,000. And in the end, the guy said, well, I'm taking the mobile guy in as well. So we bought a mobile company, sent him in, and the IT director of the customer, I think, thought, sod it, you've got everything else, you can have my mobiles as well. And we took this customer from spending £8,000 a year with us to £326,000 a year in a space of 18 months. Now, we didn't replicate that across our base, but that was a theme that we tried to replicate across all of our customers. And in the end, we had 82% of that customer's telecom spend. So the point I'm trying to make is that it wasn't transformational in terms of one big hit away you go. We did several acquisitions that built up a capability and a credibility, and we delivered numbers like that, which resulted in 22% organic growth. The best competitor in the market was running at 5%. They announced results yesterday and are still at that level. And another company is running at, probably the biggest in the market, is running at 1% organic growth for the next 3 years. So not the obvious benefit of acquisition, but that was absolutely transformational for us. Very briefly, the risks of integration are very well publicised. I've heard some stats that say that 50% of acquisitions fail to deliver shareholder value. I got lots of things wrong in the early days. As I said, we made less mistakes as time went on. I'll be very brief on this. Core systems are absolutely key. We bought one company and we let the vendor manage the core systems for us. It was a massive mistake. He had us where it hurt. And to compound matters, I then believed one of my guys who said he could build that from scratch. And going back to that learning curve point, it was a huge mistake. Never again will I leave those core platforms from any acquisition in somebody else's hands other than our own control. And secondly, management. Believe me, we bought 12 acquisitions and some of these guys were complete fruitcakes. They were absolute nutters, the guys who ran these companies. And I remember one of them, we sat down as a board and we said that this guy wants a board seat, we're going to have to let him have it. And we all knew what was going to happen. It was just a nightmare. He was political, he was disruptive, he was corrosive, and it was a huge, huge mistake. And I won't go through that again. Don't underestimate the cultural issues, even in small acquisitions. As a general rule, we bin the MDs because they don't really want to come and work for me anyway. We diligence the second layer of management and say, massive opportunity for you, your old grumpy boss is gone, if you get this right, you're going to run this business going forwards. Second layer of management was key for us. So we exited in November last year for £37 million. We spent 19, and despite some real low points on the roller coaster, it was a fantastic journey. It was a real privilege to be a part of it, and as I said, it did feel like the best job in the world. That was in November last year. I had some period of non-compete, and now we're looking at SpiriTel 2.0. So it's going to be very similar. Why break a model that works? We're going to do buy and build again. It's going to be an integrator model. By that, we're going to do the full range of services again. It's going to be a one-stop shop. We're going to focus on cross-selling again. We're certainly going to try and deliver that double-digit organic growth as we did last time. We're going to put equity and debt in there. I'm astonished how many decent businesses haven't got any debt in the business. Ian didn't tell me to say that. We had a great relationship with our bank through the period. And I would encourage you, there is money out there both at an equity level and a debt level. As Sharon said, go and ask questions, talk to people. If your business is solid, it's got some track record, there is money available for you today. And also, going back to the point made earlier in terms of relationships, I've got my same CFO, I've got my financial controller, I've got my PA, I've got my operations director, I've got my head of systems, I've got the same deputy chairman, and that is just the dream scenario for me. I've even got the same equity backers as well. So it's going to be very similar. The difference is probably going to be that we're going to spend a bit more money. So last time around we spent 19 million. I'm surprised but delighted that we're oversubscribed in our current fundraise. We're raising 40 to 50 million of equity and putting 20 million of debt in there. It's going to have a data focus. Remember those charts that we said earlier? We were voice centric last time around. The market's moved on. So guess where we're going to position the business next time around? We're going to do data. And for various reasons, which I'll have to talk to you about another time, we're going to be private rather than listed. Really quick overview of our strategies to try and give you a view of the big picture. We're at stage 1 at the moment in terms of platform acquisitions, trying to set up this complete business communications product portfolio. No cost synergies. This isn't the stage to take heads out. We're buying businesses that are good at what they do, and the worst thing we could do is go and rip costs out. That's not to say that we don't do that, because at phase 2 we will. This phase is about trying to deliver our organic growth, deliver our cash conversion and earnings visibility, all sorts of things people like Sharon and VCs and bankers like to see. Phase 2, which will start later this year, is the bolt-on acquisitions. As I said, we did 12 of these last time round. This is all about executing cost synergies and integrating properly. I'm astonished how many businesses that go through an acquisition program with seemingly little or no integration. We developed our own bespoke integration framework. It's not rocket science, it's a 590-line spreadsheet. It just means that we don't leave any stone unturned. It starts 90 days pre-completion, it carries on 90 days post-completion, and we obsess about integration. Same focus as phase 1, plus the cross-selling to deliver those revenue synergies. And then phase 3, a couple of years' time, hopefully we'll be able to demonstrate that we are a fully integrated service provider, that we're fast-growing, we can deliver strong earnings visibility and cash generation. That's the master plan. We did it once with a few mistakes last time round. I hope to make less mistakes this time round. And then at some point, hopefully, we can deliver an exit. That's me done. In conclusion, I suppose I would just like to encourage you, really, to have a go. It's not acquisitions or organic growth. It's acquisitive growth that can underpin your organic growth. And go and do an acquisition, make it a small one, but see the benefit of the Haribo effect. And for your benefit, this week I went to see my son and stuffed him full of Haribo sweets. I gave him a can of Coke, and that's what happened. No. I didn't, so please don't call social services. Acquisitions can be transformational, whether it's one or whether it's a series of acquisitions. And I'd like to reassure you, it's not rocket science, because if it was, nobody would give me £60 million to spend on it. Thank you very much.